Hello, everyone. Welcome to Tuesday Tax Tips, a special Tuesday afternoon networking seminar. I was wondering why people in America move 3 times as often as people in Europe do. So I did some research. It turns out that Americans move for mostly work-related reasons, including new jobs, job transfers, and easier commutes. Logistics behind that are also easier because the US has English as a common language. One of the hotspots for relocating to is here in Bay Area because there is steady job growth as well as high performing schools from elementary schools all the way to college. So the next time you're thinking about moving, you know who to call. Hi, my name is Coco Tan. I'm a realtor at Keller Williams Realty here in the San Francisco Bay Area. Before we start, I want to make sure that our new viewers know how to connect with me and stay up to date on my latest listings, seminars, and informational videos. Scan this QR code to subscribe to my YouTube channel, and this one to connect with me on WeChat, and this bottom one is for WhatsApp. If you scan all three, you will never miss anything. All right, let's get started. Today we're talking about taxes. It's something you file every year, but each time the rules are a little bit different. In 2020, we had a shift in Congress and in the presidency, and a pandemic with far-reaching effects. With taxes, the goal is always the same, but the strategies may be different. Here to give us an update on the new laws and address all your questions is our returning CPA, Bin Zhai, one of our most popular speakers. Bin Zhai is a CPA, CFP, MBA, and partner. He has worked in some of the biggest public accounting firms in California. His specialties including tax planning and preparations, and as well as wealth management, which he has used to help grow small businesses for the last 25 years. Bin Zhai holds a tax planning seminar twice a year, once at the beginning of the year and once at the end. He normally holds a session for only his own followers, but this year he has generously decided to team up with me to do it at Tuesday afternoon networking. Mr. Bin Zhai, how are you doing today? Are you here? Our attendees are eager to hear from you. Hello,
Yeah,
Bin.
hi. Hi, how you doing?
Hi, good.
Can you hear me well?
Yes, I can hear you very well. We're very eager to hear from you to prepare for our tax filing this year.
Sure. Okay. Sure. Thank you very much. So I try to share my screen. My speed disabled to participate in sharing. Can I sharing? It says I cannot share.
Oh, you cannot share your screen?
Yeah, I have a two sign in. Somehow my screen was not very good.
Okay, we're trying to avoid for people who are trying to make trouble. So we actually make sure you send your questions to co-host, and the co-host will actually compile the questions for Mr. Bin Zhai later on. So can you share screen right now, Bin?
Yes.
Okay.
Can you see now?
Not yet.
Okay, maybe delay. Okay, I haven't clicked the button. Okay, it's sharing now. Can you see it now?
Yes.
All right. So hi everybody. This is Bin Zhai, CPA and CFP from Zhai and Wang LLP. I'm really glad we can meet online as before. This is our first seminar on the tax series for 2021. It's officially opened as a tax season for 2021. What a special time. But I'm glad Coco provided the platform. We can see so many attendees, over 100 somewhere. I have trouble to sign up early on, so sorry if I make you nervous, Coco. I make myself nervous, you know.
Our speaker's not here. That's not good, right?
Yeah. So I have two screens. One is sharing the screen, and another one is through speaker. Okay. So if I have a slide opening, I just want to let people know 2020 tax season gonna be the last season. Probably you would see Trump's tax reform, which has a lower tax rate. And I think it's good opening to let people see what's the tax rate we are dealing with right now. So this is the tax rate we gonna dealing with 2020 individual rate from 10% have about 6 tax rate all the way to 37%. So individual make more than $500,000, a little over $500,000, we're gonna pay 37. And the couples over 622,000 gonna pay $37, 37%. And Biden probably gonna change this during the year or at the end of the year. We don't know 2021 yet. So this is actually a lower rate. A lot of people, they were dealing with the between 24% to 32% for the family income here, okay? And we're gonna come back for this tax rate when we talk about the capital gain, because I already meet a lot of clients. Is worried, is very confused about how do they pay the capital gain, what's the rate, okay? So this is just the overview about the tax rate. We still can enjoy to the end of 2020. And what's gonna change? I think we should open with the new change on the, we are in the special time in the coronavirus, and everyone, no matter you or your kids, probably get stimulus check. Government issued two times. First time at $12,000 per individual who is qualified. The second time is at the end of the year or the beginning of the year for $600 per person. So by April 15th, by the law, all the 1099, 1098, W2, 1095, and in this year, there's a new form called the 1044 NEC, stand for non-employee compensation for subcontract. You will receive those in your mailbox. So you're officially ready to collect all the data, give to yourself if you prepare the TurboTax, or give it to your accountant to prepare the tax return. There's also a new notice letter called 1444, gonna send it to you if you get a stimulus check. IRS use that form to tell you you already received the stimulus check already. For the people who don't get 1444, even you don't need to file the tax return. We recommended them to file the return, because that's the chance you will prepare your 2020 return, get the stimulus check. So basically, individual income under 75K, the couple's income under 150K, you probably gonna qualify for 2 times stimulus check. Total added up, each person could be as high as $1,800. Okay, and the Biden probably gonna have more. So filing 2020 return will make you qualify for the old stimulus check and probably some new stimulus check. The official name for the stimulus check called Recover Rebate Credit. If you didn't get it, you make sure file the 1040 return online 30 to claim that number, so you will get your money for the recovery rebate credit. Okay, so that's a new line. And a lot of people also, unfortunately, they losing the job, and that they applied for California unemployment benefit, which is called unemployment income. If you receive UI income, they are not taxable in California, but they do taxable in the federal level. So when you file the return, you make sure you only pay tax on the federal level, and don't pay it on the CA level. Okay. And small business owner, if in the early time, government Congress released called the EIDL loan, some kind of emergency loan, and it's later become grant. And EIDL grant doesn't need to count to the PPP loan, but they do taxable. Okay, they are taxable. They consider as a revenue to you, so they are taxable. No matter you get a $1,000 to $10,000. Some city even have a city levels subsidies. All those grant are taxable. Okay, and also there's a massive tax bill called CARE Act passed in the end of March, and there's a lot of revision. And I know there's a lot of my clients are self-business owner. They are in the audience right now. So on the next slide, we're going to talk about a little bit about the PPP loan. So for the PPP loan is a subsidy you get for to subsidize your payroll paid to your employee. So small business owner and the self-employed may already receive the first PPP funding from the SBA. All those funding may be forgiven if the fund you spend on the qualified expense like payroll, utility, telephone, and the rent in the 8 weeks or 24 weeks. And among our client, we are busy to get those loans forgiven. And we meet some rules about if you didn't lay off any employee, if you do lay off an employee, you should take a look at one thing called a full-time equivalence calculation. So I put the 2 period. If you have a more employee before the coronavirus outbreak, and you have a less employee now, you probably should reduce your loan. So by the reduction means you need to pay back some PPP loan. But we found they also use another reference period. You can find in 2019, if your employee headcount is lower, maybe your reduction was not that bad. So I put the 2 periods over there, and do talk to the who understand this. Your banker probably doesn't understand all those calculations. So if you need any consultation, do give us a call, because the PPP loan is really big. Somebody get $100,000. If you have a 10% job, you need to pay back $10,000. So that it is worth to understand this. And a lot of forgiveness and all the salary wages should be restored at least by the end of December 31st, 2020. Or by the time you submitted the application, okay? And I have a lot of accountant, I have a client's accountant to call our firm to ask, is a PPP loan, shall I including those as a taxable income or not? As already said, even you got forgiven, the PPP loan should not be counted as a revenue. You know, you don't have to including those in your revenue. But IRS also said the money spent on the payroll by the PPP money should not be counted as an expense too, okay? So I have some very deep conversation with their accountant. What's the good way to do it? There's a lot of way. You probably can count it as a revenue, and then you don't have to move the expense, or you can move the expense by a lump sum line. You know, IRS doesn't give our very clear about how to do this, and we are accountant. We are here to help accountant to make decision, because this really gonna impact on the tax what you're gonna pay. But one good thing is if you're filing Schedule C, you don't have to count the PPP as your revenue, and you also doesn't have to reduce the deduction by the PPP money, what you get. Because the reason I found in IRS code is because you qualify not by the expense, you qualify by the revenue, your net income. So this is a really good tips for a self-employer. You don't have to reduce the money you spend on the PPP. So for those people that don't have a PPP, you probably get lost already. So let's go back to another important deduction over here. This is tax deduction and the tax credit. I always ask our staff, which one do you like? You like the credit or deduction? And after you prepare tax for a while, you should answer that the tax credit is more attractive than deduction, unless the deduction are really big. Okay. So that means that because the tax credit reduce your tax dollar by dollar, the tax deduction is above the line deduction. That means before they calculate the tax income, they reduce your income. Like for a couple in 2020, you can reduce your income. The first 24,800, they are not taxable. For the single, if you didn't make 12,400, they are not taxable either. And the child tax credit was passed by 2017 Trump tax reform. So if you have a kids, even you live in the Bay Area, have a high income, you probably still can get each kid under 17, you get $2,000 deduction. And for the kids over 17, like 18 under 19, you get $500. So there's one thing you should consider about if you want to get the tax credit here, you probably won't be able to get the stimulus check, because if the 18 and the 19 kids, if they want to get the stimulus check, they have to file in tax independent. They cannot claim as your dependent. So purely on the mathematical comparison, we will recommend the kids to file the return independently. So don't claim as your dependent. So they will get $1,200 instead of $500 for the dependent credit here. Okay. And I have another table next is in the pandemic, everything is going down except the stock market and the real estate market. I guess there's access for money. People still want to spend on the investment because everybody worry about the inflation. So stock market and the real estate going up a lot. A lot of people trading the stock and have a good income over here. So the capital gain, they actually have their own tax bracket too. They instead of have a 6-layer tax bracket, the capital gain actually have a 3-layer, 3 level of the tax. So for individual, if your income is under $40,000, any long-term capital gain, you don't have to pay any tax as long as your W-2 and the capital gain doesn't add up more than $40,000. Remember, this $40,000 is taxable income. That means you already deduct at least the standard deduction. So for $12,000, 400. So technically, if you don't make 52,400 on your combine your W-2 and the stock gain, like a lot of students, they just graduate, have only half-year job, and they participate in the stock trade, make some long-term investment. all those stock combined with W-2 not over 52,000, and the taxable income not over 40,000, all those long-term taxable gain are free. Similar things for some joint filing. Let's say if you just retire, you live on your saving and a very small Social Security, and you sold a lot of stock. As long as the total gain is not over, let's say, $80,000 plus the standard deduction for 24,800. So you can make a little bit over $100,000. You don't pay the capital gain, you know. So this is one thing we talk about in the year end for the people who sell the stock. As long as make sure their income is not over $100,000, all those capital gain can be free, you know. But your income goes up. Let's say for a lot of people, their income is above $80,000, but lower than the $500,000, you probably only pay 15%. But if your combined income over about $500,000, 496,600 here, you pay long-term capital gain about 20% over here. Over here, I just emphasize what you see the rate is only for the federal level. In the California, it's actually have another 9.3% rate. California doesn't have a capital gain. We only have ordinary gain. No matter it's long term or the short term, they pay your tax bracket. So, and plus there's another tax called the Obamacare tax, 3.8. If your capital gain income over 250, there's another 3.8. So let's say if you're a high income earner over $500,000, your total tax rate combined the Obamacare and the federal and the state could be as high as 35%. Okay, so let's just remember those. Okay, so those the capital gain. Our next slide is talk about, since we are the tax season here, and I know a lot of audience over here prepare your own tax return, and I try to provide a service for those clients and for the new client from the COCO side, you know. So those the things I accumulated in the years we prepared tax return for individual. When you prepare the return, and have a summary checklist over here. Okay, so if you have a medical expense, anything over your adjusted gross income, which called the AGI, more than 7.5, they are tax deductible as itemized. Okay, and the cash donation in after 2017. Tax reform, it's not, it's increased up to 60% of your AGI. That means you can donate your total income as high as 60% of income you can donate to the charity and get the deduction. If you donate anything other than cash, it's 30%, okay? And I have some clients, they have to take care their disabled relative, their parents getting old, have a care provider, or some kids really need long-term care in home. All those payments from the state government, which is called IHSS, the tax payment before they are only tax exempt on the state level. And after 2017, they also exempt on the federal level. So if you get those home care service payment from the government agency over there, you probably can exempt an amount. If they give you a W-2, you need to report the W-2, but try to offset those W-2 in somewhere on the tax return to get the exemption, okay? And that's probably the things I see for the people when they prepare their own tax return, like a TurboTax. The computer probably cannot tell you about this. And there's more deduction on the business sides, so business owner, they can deduct about the business mileage. If you diligently track the mileage, you visit the client or drive your car for business purpose. 2020, the per mileage per diem deduction is 57.5 cents every mile. Okay, so if you drive 10,000 miles, you can get a 575 deduction. If you drive 10,000 miles, it's 5,700. So those will save your time to collect all the gasoline receipts or the service bill. You just deduct on the per diem. And a lot of people are during the pandemic only can work from home. If you're self-employed, try to claim all those home spending on the form 8829 and attach it to your Schedule C. They can deduct a lot of those deduction. Particularly, you should claim those when your property tax cannot be deducted on your itemized. So if you claim those on the home deduction, you actually deduct more. Okay, and for the business spending in last year end, I tell client try to buy more stuff, and the physical spending on the RC code, Internal Revenue Code 168 and the 179 deduction. Basically, it's bonus deduction and the total full deduction in the first year. And a lot of people always ask me, if I buy the car, can I deduct the whole car? And I just list over here, IRS does have the regulation for the normal car, especially when you drive a luxury car. Not everything are deductible. The first year IRS only allow you to deduct $10,100. Second year, no more than $16,000. Third year, $9,000. Some qualified vehicle can add another $8,000. And business deduction on the car have to prove you used the car by 50% for business. So any number I show over here has to be applied by the business use percentage, okay? And also for the meal, we don't have entertainment deduction anymore, only the meal. The meal deduction is only 50% on your tax return. And we also gonna talk about a lot for the pass-through entities. That's for the business owner to claim the deduction. Anything qualified business can reduce 20% of their earned through the tax code 199 Cap A deduction. And also in the CARE Act, allow the business to reclaim their net operating loss. If they have any loss during the 18 and the 20, they can go back 5 years to reduce the year on the tax they already paid. Probably if I amend the return, and if you don't know how, give us a call. We probably can show you how to get the money back. Okay. And there's another interesting things throughout the year we prepare this is not all the time California is conformed with the federal tax regulation. And particularly after Trump time, a lot of the tax deduction either reduced by the federal government, California still allow you to do. The first thing is I found that a lot of people thinks the SALT deduction, SALT, stand for state and the local tax. Only no more than $10,000 are deductible. And a lot of property, I believe a lot of audience, you pay more than $10,000 on the property tax already, you know. So all those property tax are deductible on the federal side. Please make sure you did it right, not only using $10,000 on the federal side, okay? Because California do allow you to deduct all the property tax. And California does not confirm the casualty and the theft loss. That in 2017, Trump's tax reform did disallow any casualty and theft loss deduction, but the California still allowed. On the federal side, right now, only the disaster areas victim can claim those, like the wildfire victim can claim this on the federal side, but on the state side, they're always allowed. Okay, but unfortunately, California doesn't allow HSA deduction. You know, any money you put into the HSA, you only get the deduction from the federal side, not really on the state side. Okay, and California doesn't have an education credit like in the federal. The federal government can pay for the college for $2,500 through the AOC tax credit, which is called American Opportunity Credit, and the Lifetime Learning Credit, LLC, for $2,000. California doesn't have that. And also, Trump tax reform allow 529 to be distributed for K-12 students, means before high school, before college, you can spend 529 plan. California doesn't allow this, and you cannot take $10,000 for the deduction. If you do take out, California also can charge you 2.5 penalty on the gain, you know. And alimony after 2017, they delayed a year. Alimony doesn't have to report it on the payer, on the receiver end and on the payer end. You don't need to report the alimony anymore, but California still allow you. Okay, you can, if you pay alimony, you can still deduct those from your taxable income on the state side. Okay. And the 179 deduction on the California is very small, still stay at $25,000. I remember when I started to prepare tax 20 years ago, they are only 25K. Right now, still 25K. But on the federal level, it's already over $1 million. You can deduct $1 million more, you know. And the California doesn't allow the 72 and a half people. If you're over 72 and a half, you can still contribute to RA because the Secure Act move up the minimum withdrawal to 72 years old. So, but California still stay at the 70 and a half. So after 70 and a half, you cannot contribute on the state side for RA contribution anymore. Those $7,000 you cannot do. I already mentioned California doesn't have a capital gain. They only have an ordinary gain. Any gain you sold depends on your tax bracket. Tax bracket. Majority of people, if you earn more than 80 or 90,000, California tax rate already 9.3. And it can go up all the way to 12.3 if you close $1 million. If you're over $1 million, California highest rate is 13.3. It's very high, you know. And we already talked about the NOL in the previous slide, okay. And we move to the small business benefit deduction over here. Any small business owner over here, just remember when you file tax return, please take a look if you buy any fixed assets. If you buy fixed assets, you can deduct them in the first year when you buy, either through the bonus depreciation 100% deduction, or through the 179. There's another beginning in 2018. If you are a small business owner, either in the C corporation, S corporation, or self-employed, any income you make from the business, 20% can be reduced. You don't have to pay the tax. That's benefit for 2017 Trump tax reform. He reduced the corporate tax rate from 35% to 21% on the corporate level. So for the pass-through entity, to prevent people to change to a C corporation, they allow you to deduct 20%. So partnership, S corporation, and rental activity. If you have a rental property, if you have a gain, don't forget to deduct 199A cap deduction. The calculation is pretty complicated. I hope you using a software to do that. Otherwise, it's very hard to do manually. And what is the qualified business? The business has to be sourced from the United States. You cannot earn your revenue from overseas, and no investment income means you don't. Your business is not merely to sell the stock or sell the real estate. Those are not qualified. But the rental business do qualify, and they also have a safe harbor rule. Basically, require you to prove on the rental business you spend 250 hours, and you keep every rental separately. You can show the business income and the revenue. You can be qualified. And there's a specific service like a CPA, physician, and attorney. We only can deduct certain income. Let's say under 322K to 400K, and under that income, we still get some proportion, 20% deduction. But when you over 400K, the 20% 199 cap A deduction are disallowed for the licensed professional. But the one group are exempt. The engineer, like a lot of software engineer, the hardware engineer, if you do your own business, or the income you make, they're exempt. Architect, sales, realtor, and we always joke says the realtor and the insurance industry, they have a much bigger lobby power to persuade Trump to allow them to get 20% deduction, no matter how much income they make, So those people are qualified to get 20%. And the last area on the slide, I want to concentrate on the foreign tax claim. We have a lot of clients coming from overseas as a new immigrant, and they're surprised by the United States tax system was so complicated, and that they want to know so much more, and they tax a lot. Like if you own a foreign country stock business more than 10%, you need to report on your tax return. You need to file a special form called 5471, and if you have an income, if you have bank account over $10,000 or investment account over $50,000 as a single, you have to report it, okay? And those are very complicated return. I don't think normal tax return can handle those. That's when you have such situation, you should really talk to professional. And the new immigrant need to not only report their business dealing, they also need to report anything you earned from overseas. The United States have a tax treaty for more than 100 countries all over the world. China was in there, Hong Kong and Taiwan doesn't have. Okay, but still you get the tax. You got some benefit to report those. The first 100,000, $108,000 can be tax exempt, but you have to report it to get the exemption. Otherwise, if you, I met a lot of clients says I didn't make more than 100K, so I don't need to report it. That's probably wrong. You have to report it before you will get exemption. You only can put on the tax return, then you get exempt. Okay. And there's a rule to be qualified. Normally, you need to stay overseas more than 330 days in the first year. Then afterwards, you have to document your tax home is overseas, not in the United States. And I also have a lot of clients. Their spouse is working overseas, but their kids and the other spouse stay in the California. California have a special rule about the community income. So any income earned by the foreign spouse, the 50% income should be reported in the California too. I reviewed too many tax return prepared by the TurboTax and the card by the FTB. They didn't report this, so they could have filing trouble with the California state. Okay, and if you report it right, you can avoid the double taxation from overseas country and in the United States, because United States, when you have a tax treaty, the foreign tax credit is allowed. You can offset the tax you pay the overseas government dollar to dollar against the United States, but still you need to report it. If you don't report it, not only you violate the rule, you are not compliant in the tax code, you're probably gonna pay very hefty penalty too. So that's why we recommended, if you have a new on the foreign income and the financial assets streamline, you do need to keep a good record. Even your foreign institution doesn't provide anything, you need to keep the document on your own. And in the last, I will put a lot of jargon over here: FBAR, FATCA, PFIC, CFC, and the on the GILTI tax. Those merely the summary about the foreign income and the foreign assets, foreign ownership, the company ownership. All those need to report on the different form. On the form over here, okay, sorry. On the form over here, each of the category have their own form. All those form are very special form. They require special service too. Take a look at those. If you have any one of the situation over here, it's the good area to talk to the profession. Don't do it on your own. It's very dangerous to handle on your own. There's a lot of story about the actor called Yin Da from China and the professor Chen from MIT. They probably they did something wrong. They either honestly forgot something and they pay the hefty penalty, or even have it indicted by the US government. So try not to do it on your own. Let somebody else understand to handle those. In the last, I just want to put our firm's service over here. We do tax preparation service. Normal form only start from $350. Depends on your special situation. Some situation over here, like if you have a self-employed, we charge 150 more. Every rental charge 75. The foreign are special too, another 150 over here. You can see the chart over here. We also provide the 10% discount for the good referral, and our fee over here also covers complimentary consultation, normally 30 minutes in a year, or you can break down to 2 15 minutes call to us over here. And I try to maintain a WeChat group to answer the question, not only in the tax season or throughout the year. Sometimes I'm late, but I try to provide some community service over here. So Coco, I finished my presentation. You can help me see if anybody have any questions.
Oh, thank you so much, Mr. Bin Zhai.
Thank you.
Yeah, so if you don't mind, unshare for 1 second, and then we can try to just give an introduction for the next seminar, and then we can bring back the QR code for people to scan.
Sure. Okay. Let me stop sharing.
So I want everybody to know that the questions you have typed into the chat to our co-host has already been collected and will be answered by Mr. Bin Zhai during our Q&A session. We also have some questions from our stream viewers on Facebook, YouTube, Weibo, and Yijibo. Before I get into our Q&A, I want to tell you what's coming up in the next 10 seminar. Next week is another cooking seminar with our master private chef, Michelle Chen Li. As we're drawing closer to the Chinese New Year, some home cooks may be in need of some inspiration and new ideas. So she will be showing us how to make Shanghai egg rolls and family fortunes using only very simple ingredients. So tune in next week, February 9th, for Cooking with Chef Chen, Chinese New Year special edition. This special edition will be conducted in Mandarin Chinese. So if you don't speak Chinese or prefer to order takeout, come back on February 23rd for the return of our Investors Medley session. Part 4 is titled Renter's Rule, Stories from Property Management. So if you own a rental property or an investment property, you may be wondering if it's better to use it as Airbnb or a traditional long-term lease. We will have a panel discussion with Cindy Lin, an Airbnb investor, and Allison Dean, a property manager. They will be sharing their experience and challenges. So it is for sure will be a very exciting session. Renter's Rule takes place on February 23rd, and it will be conducted in English. So now we're ready to direct some questions to our guest, Mr. Bin Zhai. So I have this question. So Mr. Bin Zhai, if townhomes and condos, since they're not selling very well, if we sell for a loss, can the loss be tax deductible for this kind of capital gain loss?
So the condo is a rental property or a
primary home?
Primary home loss are not a tax deductible. Secondary, if you don't put on the rental, they are not tax deductible.
Okay, so if it's rental, then it's tax deductible then, okay.
Yes,
all
yes.
Right. Okay, so from Sean, can realtors get PPP as self-employed and the loan can be forgiven if you have no employees? Can the loan be forgiven? Yeah.
Yeah, if you conduct your realtor business in the self-employed or through the S corporation or LLC, they are qualified.
Okay.
Yes,
and there are many
you can get
people,
the PPP.
Okay, thank you. There are many people asking for the slides for the tonight's slides, and then if you want to get the slides, you can email me. I guess you can email me. I can forward the slides to you.
Yeah.
Chris can also drop our email address there too. We can you can email me, or you can leave us your email address, then we can send it to you. Yeah.
Okay. I will send it to you.
Okay, thank you.
Yeah.
From Harry, if I have a child that is 15 years old and earned about $2,500 this year, I guess this past year. Can I file taxes for her separately so that she qualifies for any stimulus payments this year?
No, you don't have to file separately. 15, 17-year-old, even you file separately, they won't treat as a separate individual, okay, for the stimulus check purpose. They basically should file with their parents. Before you get the $600, right now everybody get $600. They can file with their kids, with the parents.
Okay.
So I think her question is maybe she doesn't qualify. The parents doesn't qualify.
Just for
I
the
think
kid.
what she meant. Yeah, only file the kids try to get $600. Normal, as far as I understand that the original $12,000, if you file separately, they don't count as an individual. Okay, only the kids beyond 17-year-old can file independently. Okay, under 17 cannot. Okay. Yeah.
All right. So make sure you type your questions to Chris so that Chris can make sure to publish in the Zoom meeting. Because sometimes if you private chat me, I may miss it. From Joni, is capital gains added to income for total taxes?
Yes, for the taxable income. So in my chart over there, the taxable gain are treated as the total income. Let me go through the gain over here. Yeah. Yes, the capital gain, when you calculate the tax, take a look how much income you have. They add on the top of a W-2.
Got it. Okay. From Lotus, for the long-term capital gain rate, is there a phase out? For example, if your taxable income is less than $80,000, among them 50,000 is long-term capital gain. Then if your taxable income is 85,000, among them you have 50,000 long-term capital gain. Do you need to pay 50,000 times 15% for taxes?
No, I'm looking at on the chart. Yeah, it's a lot of number here. So what he asked, if your taxable income is over 85K, among them you have a 50K long-term capital gain. So do we need to pay? No, the 50,000. So if you have $85,000, if you are single or married, let's assume this married couple, if their taxable income is 85K, only $5,000 gonna be paid the capital gain. Okay. So if it's a single, then 35K need to pay the 15%. Anything under 40K, they are tax exempt for the capital, for the long-term capital gain. Okay.
Okay. All right. So same thing, same question along the line for long-term capital gain from Tito. So when you have 15% or 20% rule, if you are married filing jointly and have $100,000 capital gains, does it mean 15% if you earn $496,599, and once you earn $1 more, it suddenly become to be 20% on the whole 100,000?
No, only the portion over 496K by $1. Only that $1 you're gonna pay 20%. Everything within the 80 to 496K, you still pay 15%. That's the same thing at the tax bracket. You know, within the bracket you pay that rate. Anything above that bracket, you pay the higher rate.
Got it. Okay. From Terry, when being mentioned that EIDL is taxable, I want to understand if I receive EIDL loan of 150,000, then that is the loan and should not be treated as income. Is that correct?
Yes. Yeah. I said EIDL grant are taxable. EIDL loan are not. Okay. she said the loan. If you got a later EIDL loan, you still need to pay back, and you have a payment schedule with SBA. You probably doesn't have to pay that. Only the EIDL grant, they have a $1,000 to $10,000 grant in the beginning. Okay. Yeah.
Yeah, from Dasharath, can self-employed people deduct their auto expenses? And one more, when you mentioned about Obamacare taxes, if total capital gains greater than 250,000, is that for total income or capital gain? Does that make sense?
Only the capital gain paid 3.8. Those the investment income will pay 3.8. Obama tax is never taxed on the revenue or on the W-2. They only tax on the investment. So a lot of people call it the Warren Buffett tax because it's coming from Warren Buffett. It says he make a lot of money, but his tax rate is lower than his secretary. So Obama come out says, then I will tax you guys for the investment gain, And the interesting is Biden probably gonna come up to tax more, The very deadly one of a proposal is if you make capital gain over $1 million, your capital gain gonna become ordinary rate,
Oh, wow.
So, yeah.
That's going to be a lot, yeah. So
yeah, that's we're gonna see.
Yeah.
Yeah.
Go ahead.
Dash probably has another problem over here.
Yeah, he was asking you if employee deducted for the auto expenses.
Auto expenses can be deducted either by the loan or by the either through loan. No, either through the per diem. What I say is through the mileage per diem 57.5 cents, or by the actual spending, and then you multiply by the mileage percentage, So it's one called the per diem method, another called the actual method.
Okay, and from Sandy, you show the long-term gains for single and joint. What does the short-term gain tax look like?
Short-term gain is the same as ordinary gain. So whatever your W-2 paying, the short-term gain paying. So if you make if your tax rate is at 32%, then you pay 32% rate.
Okay. So if I recently purchased a rental property and it's currently being renovated and it hasn't been rented out, can I report that as a loss?
No, you cannot rent it out. If you don't rent out more than 14 days, IRS does not allow you to report it as a rental. So you have to rent out at least 14 days in a year to call it a rental.
Okay.
All those, let me just get all those expense, development expense, improvement expense, you should track them down to put it as a cost base in the purchase the property. You cannot deduct against your W-2,
Okay. And from Lillian has a more complete question. I guess you can just hear this question, see whether you can have a quick answer. Otherwise, we can take this offline. Basically, California has no capital gain tax rate. Is this after 2020? So she doesn't understand those listed on the CA does not conform with federal tax regulations.
Well, it's since forever. Everything I know, I prepare tax for 25 years. Everything I know, California doesn't have a capital gain because California only have an ordinary gain, So you probably, either you never pay attention or you produce your tax by the tax return. I only found out this is by the discussion with my client, a lot of client was very surprised so California doesn't have a capital gain. I told them California always pay ordinary gain. They are so surprised, So I try to tell client, California, they tax you at where you earned. It doesn't matter you hold the stock for short term or long term.
Got it. And from Chris, can the bank savings account interest be offset by capital losses?
No, they cannot. Only by $3,000 on the capital loss, no more.
Okay.
Yeah.
And then from Debbie, the 250 hour, including the hour that contractors spend on doing their
Yes.
repair work?
Yes, everyone on that property, your property manager, you and the repairman, the subcontractor, the gardener, if you can track how much hour they spend on that.
Okay. Okay. And from Lotus, what is foreign income exclusion up to 108,000 foreign housing exclusion? Can you please explain more on that one?
That means you can claim the $100,000 exclusion on your salary, and also if you stay overseas more than enough days, your rental, you pay for the apartment in overseas can be deducted too. So if you 108K plus all the rental, if you spend like 30,000 on the rental, there too can stack up to do the exemption.
Okay. From Jerry, what tax deduction or credit can we get for 2020 working from home for our companies? I used a dedicated room as office for my work.
You probably cannot for the W-2 owner. So that's why I said you only can report home office use for self-employed. For the employee, the best bet, like I said in last year's ending seminar, the last bet is you have your company to reimburse you, not through the tax deduction, because Trump take out the miscellaneous deduction as itemized. So you probably cannot claim as an itemized deduction anymore, only through the business,
Okay. And from Tito, for Bean, how much money do you charge as tax consultant fee, usually for people who you don't file taxes for? Do you do a consultation?
Yeah, we do during the half hour. We do tax review. A lot of people are not sure they're tax filed by the TurboTax and have a very special situation. We help them to do the review. If a full return review, we normally charge our normal fees 50%, or depend on the hour fee. Our partner charge is 250 every hours. Hourly fee is 250.
Okay. And from Terry, how much do you charge for S Corp taxes?
Standard fee is $1,000. You just need to provide the financial statement. Then we only do the tax accountant for $1,000.
Okay. And from Crystal, can you explain if property tax will be deductible?
Property tax on the federal only deductible up to 1,000. Combine your other state tax. On the state, they can deduct 100% on the state return.
Okay. From Lin, my question is, if someone has a house in China and never rented and or have any gain from it, just for self-living, and bought before he come to the US 20 years ago, should it be reported for taxes?
Yes, and as a capital gain. Your first sell at a gain, you need to report. So this is what combined with the previous question. So for self-living or empty vacation home, if you have a gain, they are taxable. If you have loss, they are not deductible.
Okay.
So that's just an IRS rule. No matter where the location. Because U.S. is worldwide taxed, so even you bought it before you immigrant to United States, it will become United States property to report when you get a green card. you know.
Okay. From Baoqing, my son, who is a college student, filed for his tax return independently for 2019. However, we filed manually and missed the education credit. We can file a rectified return to get it back, correct?
Yeah, you can file amended return in last 3 years, all the way to 2017.
Okay. From WW Round 2 EIDL grant and PPP loans and forgiveness qualifications, if you can clarify that. And also, can I apply for both PPP and PUA, the Pandemic Unemployment Assistance?
You can apply as long as you qualifies. Okay, the second PPP, which can call second job PPP, is underway. You should take a look at the criteria. Is every quarter, any quarter during 2020, the sales drop 25% compared to 2019, then you are qualified. Okay. And can you apply PPP and you PUA, right? He said
both PPP and PUA.
I don't think you can double dip it normally. Okay, so you should decide which way you want to go. Normally you only can apply one, because when you apply PUA, they will ask you a question: did you get any federal government grant and stuff? You know, if you answer yes, maybe will disqualify you. I'm not the expert on the UI loan because it's in individual level. We don't help client to do, but as far as I understand, if a PPP yields small, you should get a PPP. You can in the meantime apply PUA. You know, in the beginning I did see somebody succeed with this, but it doesn't mean it's right to apply both. You know.
Okay. Okay, and then if the PPP loan forgive, I do not need to enter the loan record into the TurboTax. Is that correct? From Chen.
Yeah, the PPP proceeds doesn't count as a revenue, but the money you spend with PPP money cannot be counted as an expense. So basically, you need to do a calculation to take them out. And there's a lot of tricky question over there. Even RS doesn't provide an answer right now, because like if I haven't got it forgiven yet, do I need to take the expense out? We normally take conservative way. We suggest client you remove the money out by the money spent by the PPP funding. You know.
Okay. Jackie, how much do you charge for private consultation and tax planning?
Still hourly fee $250.
$250 per hour. Okay.
Yeah.
From Sudhi, can we carry over stock loss for future years?
Yes, all the way to the end of life. you know. So.
Okay.
If you have a loss, you can always carry over.
Okay. From Helen, if is health insurance premium considered as medical expense?
House insurance premium?
Health
insurance.
No,
they are not considered. No. In
health
terms,
insurance. Health
are
insurance.
they considered medical expense? On the itemized deduction, yes, they're considered as an expense. Yes.
From home, if older parents live together, in order to get stimulus check, need to let the parents file their own tax, even if there's no income. Is that correct? Yes.
You will lose $500 dependable credit, but you gain $1,200 or plus $600. Yes, they have to file independently.
Yeah. So there's another question asked whether you provide service to review self-prepared tax return. The answer is yes. So I answered that for you. From Tito, following up on the question on the long-term capital gain taxes,
Mm-hmm.
The 496,599 is not just your capital gain. It also has base, bonus, interest, etc. So does that mean once you cross the limit of 100,000 and 100,000 will be long-term capital gain, you will be taxed at 20%? Is that correct?
Yes, everything added together, anything over the limit will pay the different bracket rate. Yes, you know.
Okay. From WW, if a new immigrant couple income from China are less than the filing requirements, do you recommend them to file tax returns? And what's the difference they're filing? What will be different from their filing, different from the US citizens?
Well, let's say just say if you are a new immigrant, you always need to file tax return, not solely on how much you make and how much you own. They need to report assets level. So we strongly recommend to take a look how much foreign bank account do you have. So you probably still need to file the tax return. If you don't earn too much, let's say you earn lower than the standard deduction, probably you don't need to report. But for the foreign income, I always suggest to report it because IRS doesn't have a record. It's not like you have here. IRS always know how much do you make through W-2 or 1099. If you make income from overseas, they don't know. You know, the only way to let them know is to file the return. You know, even very small amount.
Okay.
Then you can demonstrate that you don't have to pay tax on the return.
But you just have to you have to file it to demonstrate.
Yeah, in summary, I says used to just file it, you know, and they give you a good record. If you want to apply for the citizenship, you need to provide the tax return anyway, you know.
Okay, makes sense. Yeah. From Stephen, is there any tax deduction for job relocation?
I think remove cost is being repealed after 2017. No more. No.
Okay.
No.
And from Tito, fixed upper rental. So what happens to the first 3 months doing remodel? So you have property taxes, mortgage interest, stuff like that. The question is not the actual remodeling expense. It's basically the IRS question. Was it available for rental?
If you're not available for rental or the rental not available for rental, they should carve out for the expense deduction, you know. So yeah, for 3 months you are fixing up, so at least 25% of the expense cannot be deductible, applied to the property tax, insurance kind of stuff, you know. You just cannot claim them, you know.
Okay. I hope I caught all the questions.
All right.
So actually, there's some private questions to me. Was hoping you can just text to. Let me see. The long-term capital gain bracket for married couple is not the double for the one that's single. So can married couple file as 2 singles to use the lower rate?
No, you're not called two single. You filed as a married but filing separately. The rate may not be as good as a single rate. They have a IRS does have a category called married but filing separately. You cannot call your undivorced couple. They cannot file 2 separate return, single return. You know.
Okay, makes sense.
They
yeah.
are not eligible for the single return.
Okay, so many people asking for the presentation slides. So
Yeah.
Chris will drop
I
my
will send to you.
CocoTimeGroup@gmail.com. Then you can email to me and I will forward a copy to you. And then, or you can leave us your email. One more question is just want to make sure I understand a 17-year-old in 2020 makes about $10,000, filed taxes as a dependent in 2019, and plan to file tax independently in 2020. will the child qualify for the first and second stimulus check?
Yes, I think he will qualify if he filed independently. Yeah.
Okay, that sounds good. Okay.
Mm-hmm.
I think that's all the questions. And then if you want the slides, please make sure you email me, or you can leave me your email. Yeah. So
Okay.
thank you so much, Mr. Bin Zhai. I love having you on our
Thank you.
seminar because you always share so much valuable advice, and all our viewers love you too. I hope everyone is prepared to file their taxes this year. Yeah. So if you still have questions for me or for Mr. Bin Zhai, you can stay around a little bit for more to chat. Otherwise, I hope to see all of you next week or on the 23rd of February. Say thank you to Bin Zhai before you leave. I'm Coco Tan, and I hope you have a great night.
Okay.
Thank you.
All right.
Thank you.
Thank you. Thank you.
Thank you, sir.